Goldman Sachs. The name alone evokes power, prestige, and often, controversy. For over 150 years, this institution has not just participated in the global economy, it has fundamentally shaped it. From its humble origins as a commercial paper dealer, it ascended to become the undisputed premier financial institution on Wall Street and beyond. This investigation will unravel the core mechanisms behind this ascent, examining the unique strategies and structural advantages that transformed Goldman Sachs into a financial colossus, exploring its reach, its methods, and the profound questions its influence invariably raises. The journey began in 1869 when Marcus Goldman established a small commercial paper brokerage in New York. Initially, the firm focused on facilitating short-term loans for merchants, a relatively niche but vital aspect of commerce. This early specialization, as financial historians note, provided an intimate understanding of capital flows and credit risk, laying foundational expertise that would become crucial. This initial focus distinguished Goldman from more traditional banks, setting a precedent for its adaptive and specialized approach to financial services. A cornerstone of Goldman Sachs's early and sustained success was its unique partnership structure. Unlike publicly traded companies driven by quarterly results, Goldman Sachs remained a private partnership for over a century. This model, as financial analysts explain, aligned the interests of the firm's partners directly with its long-term viability and growth. Partners invested their personal capital and reputations, fostering an intense culture of accountability and shared destiny, prioritizing enduring strength over short-term market fluctuations. This partnership model wasn't merely a legal structure, it was a powerful engine for capital accumulation. Partners' profits were often reinvested into the firm, creating an immense, self-sustaining pool of capital. This internal capital, according to financial economists, provided Goldman Sachs with unparalleled flexibility. It enabled the firm to take larger risks, weather economic downturns more effectively, and invest aggressively in new ventures or market opportunities without the immediate scrutiny or demands of external shareholders. This independence became a critical competitive advantage. At the heart of Goldman Sachs's competitive arsenal was its mastery of information. Observers argue that the firm cultivated extensive networks, gathering intelligence on market trends, client needs, and political developments with unmatched rigor. This vast informational edge, according to former insiders, allowed Goldman Sachs to anticipate market shifts, identify emerging opportunities, and offer clients bespoke, data-driven solutions that competitors often couldn't match. Information wasn't just data, it was a predictive tool, shaping strategic decisions. This information advantage was inherently global. Goldman Sachs systematically built a formidable intelligence apparatus spanning continents, from Tokyo to London, and New York to Hong Kong. Sources suggest that reports from its international offices provided a mosaic of global economic shifts, geopolitical tensions, and local market intricacies. This comprehensive, real-time intelligence allowed the firm to identify arbitrage opportunities, predict sovereign debt movements, and advise multinational corporations with a truly panoramic view of the world, solidifying its global financial reach. Beyond capital and information, Goldman Sachs honed risk management into a sophisticated art form. While other institutions chased aggressive growth, Goldman Sachs, according to financial journalists, developed meticulous processes for identifying, quantifying, and mitigating risk across its diverse operations. This wasn't merely about avoiding losses, it was about understanding risk-reward trade-offs with unparalleled clarity, allowing the firm to take calculated, high-stakes positions that often yielded significant returns, particularly during periods of market volatility when others retreated. Goldman Sachs's robust risk management proved particularly critical during major financial downturns. While no institution is entirely immune, the firm's calculated approach often positioned it to not just survive, but to capitalize on distress. During crises, when competitors were retrenching, Goldman Sachs frequently had the capital and the analytical foresight to acquire undervalued assets, extend credit to struggling entities, or restructure complex deals. This ability to navigate and profit from market dislocations underscored its distinctive competitive advantage. Perhaps no aspect of Goldman Sachs draws more scrutiny than its extraordinary political influence. Critics often point to a revolving door phenomenon, where numerous Goldman Sachs alumni transition into high-ranking government positions, particularly within economic policy and regulatory bodies. This deep network, observers contend, provides the firm with unparalleled access and insight into policy formulation, potentially influencing decisions that affect its own bottom line and the broader financial sector. This close relationship has become a hallmark of the firm's power. This political influence is not confined to national borders, it extends globally. Sources indicate that Goldman Sachs alumni and current executives hold key positions in central banks, finance ministries, and international financial organizations worldwide. This global policy nexus grants the firm unique insights into international trade agreements, cross-border capital flows, and global regulatory harmonization. Such reach allows Goldman Sachs to shape and react to the global financial architecture in ways few other private entities can, reinforcing its global financial reach. Goldman Sachs's market dominance is perhaps most visible in its role as an architect of high-stakes deals. From orchestrating mega mergers and acquisitions to underwriting some of the largest initial public offerings, the firm consistently secures mandates for the most complex and strategically significant transactions globally. Its ability to navigate intricate legal, financial, and political landscapes for these deals underscores its expertise and the trust placed in its capabilities by the world's largest corporations and governments, reflecting its consistent market dominance. To illustrate its market dominance, consider the sheer scale of operations. While specific numbers vary by year, Goldman Sachs consistently ranks among the top firms globally for M&A advisory, IPO underwriting, and bond issuance volumes. For instance, in any given year, the firm might advise on hundreds of billions of dollars in M&A deals and raise tens of billions through equity and debt offerings. This consistent high-volume activity solidifies its position as a central player in the allocation of global capital. Despite its successes, Goldman Sachs is no stranger to ethical controversies. Accusations of conflicts of interest, particularly during its involvement in the 2008 financial crisis, predatory lending practices, and market manipulation have led to significant fines and public outrage. Critics argue that the firm's pursuit of profit has, at times, overshadowed ethical considerations, prompting intense scrutiny from regulators and the public alike. These controversies are an intrinsic, challenging part of its narrative and immense power. The 2008 financial crisis stands as a watershed moment for Goldman Sachs. While the firm famously avoided collapse, partly due to a strategic conversion to a bank holding company, its actions in the lead-up to the crisis drew severe criticism. Its involvement with subprime mortgages and collateralized debt obligations, coupled with allegations of betting against products it sold to clients, led to a multi-billion-dollar settlement with the U.S. government. This period cemented its image as both remarkably resilient and deeply controversial. A critical inflection point in Goldman Sachs's evolution was its 1999 decision to go public. This move, while providing vast capital for expansion, fundamentally altered its internal dynamics. The shift from a private partnership to a publicly traded corporation, as some argue, introduced pressures to prioritize quarterly earnings and shareholder value over the long-term, relationship-driven approach that defined its earlier success. The once private culture of shared risk and reward adapted to the demands of a global market, with both benefits and drawbacks. Today, Goldman Sachs navigates an increasingly complex and rapidly evolving competitive landscape. The rise of fintech challengers, the proliferation of passive investing strategies, and intensified regulatory scrutiny demand continuous innovation. To maintain its premier status, the firm must adapt its traditional banking models, integrate advanced technologies, and find new avenues for growth beyond its core institutional client base. This evolution highlights a persistent challenge: how to remain agile while operating at an immense global scale. In response to the evolving landscape, Goldman Sachs has made significant investments in technology and digital transformation. Initiatives like Marcus by Goldman Sachs, its consumer banking arm, represent a strategic diversification beyond its traditional institutional clientele. The firm leverages data analytics, artificial intelligence, and cloud computing to enhance its trading platforms, streamline operations, and develop new digital products. This push into tech is a clear signal of its commitment to adapting and maintaining its competitive edge in a digital-first financial world. Despite market shifts and controversies, Goldman Sachs's global financial reach remains undeniable. With offices in over 30 countries and major financial hubs across every continent, it continues to provide a comprehensive suite of services, from investment banking and asset management to wealth advisory. This vast network allows it to mobilize capital, facilitate cross-border transactions, and influence economic developments on a truly global scale, cementing its position as a central, indispensable actor in the world's financial ecosystem. The story of Goldman Sachs is a continuous negotiation between immense power and societal responsibility. Its ability to command capital, information, and influence is unparalleled, yet this power frequently sparks debates about its ethical implications and broader impact. The firm's unique evolution, from a discrete partnership to a public titan, its innovative use of competitive weapons, and its deep entanglement with global policy will continue to be subjects of intense scrutiny. The question remains: how will this enduring institution balance profit, power, and its profound responsibility to the global financial system? In conclusion, Goldman Sachs's journey from a modest commercial paper dealer to the world's premier investment bank is a testament to its relentless adaptation, strategic innovation, and a profound understanding of financial power. Its unique partnership structure fostered a long-term vision, while its mastery of information, capital deployment, and risk management became its greatest competitive weapons. Coupled with an extraordinary global financial reach and undeniable political influence, Goldman Sachs remains a persistent, albeit controversial, force that continues to define and redefine the landscape of global finance.